Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at the most important spot in its history and looking like it's ready to go on its next strong bull run, this is certainly the time to be paying attention. Now, first, to start with economic data coming out this week and next week. Remember, we have our inflation data tomorrow morning at 8:30 a.m. With where the S&P is currently, it's incredibly important we get a good print tomorrow, as premium prices call for premium market conditions and performance. We want to see a posted number lower than 2.7% consensus to show inflation is slowing versus getting worse. In addition, we have the final and official revision of our quarter-over-quarter GDP growth for Q3 of 2025 next Thursday at 8:30 a.m. If you are not aware, each month a revision of the quarter-over-quarter rate for the relevant quarter is released, each one being more accurate than the last. With that being said, the data we receive next Thursday will be the best representation of how our GDP performed for 2025 Q3. And with our last revision being a strong outperformer of 4.3 versus the 3.2% consensus, we definitely want to see continued strong revisions to confirm that growth is as strong as or stronger than initially estimated. To summarize, the last 3 months, the Fed's biggest concern is to whether they addressed our labor market weakening by cutting rates or avoid further inflation by holding rates steady for the time being. Investors have been watching closely for signs that either problem becomes more severe, impacting not only investor sentiment around economic health, but the Fed's outlook on policy moving forward. We have slowly been getting more positive economic results, with recently having a strong GDP print, a sign of unemployment starting to drop, and a recent decline in inflation. The next big thing to continue to ease investors' worries is a continued reduction on inflation impacts this Tuesday and a confirmed final revision of our GDP growth next week. Should we get a favorable print on both, this would not only give the Fed more confidence to cut, but also doing so as a preemptive, healthy decision to improve labor market health rather than a reactionary decision with a caveat of further unintended consequences in inflation. So definitely pay attention tomorrow, next Thursday, as it's sure to impact the direction of the market for not only Tuesday and next Thursday, but likely the following weeks ahead. Now, taking a look at S&P Price Action, as you can see, we have continued to bounce off that prior all-time high we realized in October 2025 and break through our market structure, marking a new all-time high. Even more so today, the S&P looks like it's getting ready to go up further. Taking a look at RSI, we have also broken not only out of that resistance zone we've been talking about, but the resistance developing since December 11th that we discussed last video. This is especially important because if you hadn't noticed, if we rejected off that trend line, it would constitute as bearish divergence between price highs and RSI highs. We now have a confirmed break in both price and RSI structures, pointing signs to further bullish momentum in the near future. Ultimately, from here, we want to continue to see prices hold above October's all-time high and the diagonal trend line from the bottom of our triangle pattern. The inflation data tomorrow morning will certainly dictate if we go back down to retest the trend line and all-time high, or if we continue to drive upwards. The first stock I want to talk about today is Oracle. A few videos ago, we discussed a trading signal with mean reversion using the 100-day moving average, which yielded an 83.5% return on average over the next 99 trading days. It triggered on December 12th and is currently up 8% on the 19th trading day out. If you want to see more around that trigger, revert back to episode 2 where I go more in depth on it. With that trigger already performing well, we have yet another trigger called trading range that triggered today. This strategy works to identify a rolling trading range of the stock and when a breakout to the top of that range is likely. Here we can see Oracle has triggered 7 times over the past 10 years, in which the price was higher by 38.2% on average when looking 94 trading days out. Across all 7 triggers, the price was higher on the 94th trading day. We recently had 2 triggers on December 24th and January 12th, marking the 8th and 9th time we've seen this strategy set off for Oracle. When looking closer at the reactions of those triggers, we have trading days out from the trigger date on the x-axis and cumulative percent change over the time frame on the y-axis. In other words, what you are viewing here is what your returns would be if you bought Oracle on each of the trigger dates and held for 100 trading days or 5 months. The blue line is the average performance across all triggers, which leads up to that 38.2% on the 94th day. In orange, we can see the trigger from December 24th begin to climb up as it's currently up 4%. As the most recent trigger begins to play out, a second orange line will start to show the progress of the two active triggers. It's important to note that these triggers are not a guarantee that the price will go up, but a useful and realistic reference of what Oracle could possibly do in the next 5 months. Taking a more detailed look at Oracle's price action, we can see the average performance for the mean reversion strategy we talked about in episode 2, highlighting what that 83.5% average return would look like. Now, adding on the average return from our trading range strategy to highlight what a 38.2% return would look like, that brings us to an upwards target of $283.32 a share around May 28th of this year, and a downside risk of $178.44 or 12.8%. All the technicals for Oracle that I noted in the second episode still hold true, so for a more detailed breakdown on them, refer to that video. However, what I do want to highlight as very relevant at the moment is our triangle break in RSI, as well as our declining trend line that we discussed about a month ago. Now that we've finally seen a break out of that region, it implies retesting our prior swing high at 224 and the top of our gap that has not been filled at $217.87 a share. From a bull's perspective, you want to see it break past this resistance zone and price to sustain above it for further upside to those target prices generated from the trade signals at $283.32 a share and $348.50 a share. The second stock I want to talk about today is AutoZone, or ticker AZO. They've recently pulled back heavily due to a poor earnings release, in the most recent quarter reporting a diluted EPS of $31.04 a share, which was down about 4 to 5% versus the expected target consensus of $32.24 a share to $32.40 a share, as reported by NASDAQ. That reporting of $31.04 a share is also down about 5% on the quarter year over year. They reported revenue of $4.63 billion, slightly under the expected $4.64 billion consensus reported by NASDAQ. So notice they achieved more revenue compared to the relevant quarter last year, yet they produced less net income per share, highlighting some weakness in their operational efficiency and that they are experiencing some margin pressures. This can be attributed to a few reasons. One being recently AutoZone has been investing aggressively in new stores, supply chain capacity, and technology, which increases selling, general, and administrative expenses and weighs on near-term margins. As what you can see, they opened 53 new stores versus 34 from the same quarter last year and reported an inventory of $7.1 billion for the quarter versus $6.2 billion year over year. The higher costs from tariffs as well as their last in, first out inventory accounting contributed to that reduction in margins as inventory increased, all leading them to report an SG&A of $1.58 billion versus $1.44 billion from the relative fiscal quarter last year, nearly a 10% increase. This hasn't been a story of just the last quarter, but the past few as tariffs took storm. So ultimately, you have a company that produced more revenue for the quarter year over year, yet produced less net income per share, leading its stock price to barrel down over 25% since September of last year, bringing us now to assess where we could go from here. Well, what could be a bullish catalyst for AutoZone from a fundamental perspective? Well, in AutoZone aggressively expanding both domestically and internationally, rolling out mega hubs and new stores with much broader inventories, this could steamroll into deeper market penetration, stronger sales performance, and ultimately better margins as economies of scale continues to increase. They don't expect to stop there as well. In 2026, the company expects 350 to 360 new store openings for 2026, which could in hand continue to boost revenue growth even more, as well as shows they still have a strong appetite and ability to grow. In addition, it's not all negative news for AutoZone. When looking at their international comparable sales, they grew 11% year over year, outpacing U.S. growth by about 4.8%. Showing that profit and growth can increasingly come from underpenetrated markets such as their operations in Mexico and Brazil as they continue that expansion. Lastly, it was noted last year that AutoZone has a strong ability to raise prices without materially hurting demand, reflecting their strong pricing power in the aftermarket parts space. This could aid leading into 2026 as companies like AutoZone have more data to adjust operational efficiencies post-tariff implementation. Now, here I have that trading range strategy again for AutoZone, in which over the past 10 years, we've seen 4 occurrences yielding 26.1% on average over the next 69 trading days. On all 4 occurrences, the price was higher when looking at the 69th trading day out. We had a 5th trigger just today, as you can see marked by the green dot. And when taking a look at reactions, we can see that average lead up to that 26.1% on the 69th day. Also notice the average dips about 1.5% the first 3 trading days, and we see some drawdowns as large as 4% over the first 20 trading day duration. This implies we could see prices lower than the trigger price in the first month before it begins to perform well. When looking past the 27th trading day, all prior occurrences were in the positive. Again, this is not a guarantee that AutoZone will go up or perform exactly like historical reactions, but rather to provide a realistic guide as to what's possible for AutoZone over the next 5 months. Taking a more detailed look at AutoZone's price action, I plotted out what that 26.1% return would look like, bringing us to an upward target of about $4,440 a share and a downside risk of $3,218 a share, or about 8.6%. Notice the bullish divergence that was playing out from April to December 2025. When we broke the support generated from that divergence, we went on to create another instance of bullish divergence that led us to currently retesting that support as resistance. Also notice that we bounced off our prior all-time high from March of 2024 on January 9th of this year. As you've probably heard me say before, when a stock breaks above its all-time high and then proceeds to hold that level of support on the throwback, it's a great sign of bullish momentum and often implies prices going back up to retest the new realized all-time high that occurred on the breakout, if not higher than that new all-time high. From here, we want to see AutoZone continue to break back above this resistance that was once support and go on to test that resistance zone generated from the 2 diagonal trend lines, as well as the resistance generated from the high in April of 2025. Should we reject this resistance, we likely go back to test the support zone near our prior all-time high in March of 2024. Now remember, I noted we saw in prior instances drawdowns upwards of 4% in the first 20 trading days. A 4% drop from the trigger price would put us right in line with the top of our support zone at $3,344 a share. Seeing a rejection here is certainly impossible, as notice also with RSI, we are just in line with our diagonal trend line and attempting to break it. Should we begin to reverse from this point in the RSI resistance, that could also be a really good sign that we are going on to realize a new RSI low and going on to retest that support zone at the bottom. Ultimately, if we can go on to break these resistance levels, it opens up the opportunity to see a retest of our new all-time high and return similar to our average of 26.1% we saw in our historical reactions. So that is all for today. If you enjoyed the video, please give it a like and subscribe if you want to see more. And I hope to see you in the next video.